What is a flip tax? In the labyrinth of New York City real estate, cooperative apartments dominate the landscape and have a unique ownership structure. To purchase a co-op, you buy shares in the corporation that owns the building instead of receiving a deed to a specific unit, and the proprietary lease gives you the exclusive right to live in the apartment. This distinctive arrangement also means that the rules for buying or selling differ from typical real estate transactions and include fees like the flip tax. Legal analysis. A flip tax is not a municipal levy but a fee authorized by a co-op's board under the building's governing documents. Because the proceeds go to the cooperative rather than the city, federal tax authorities treat it as a transaction cost, not a deductible tax. That means you cannot reduce your taxable income by claiming the fee on your tax return, but you can subtract it from your sale price when calculating capital gains. New York co-op owners may also benefit from the cooperative and condominium tax abatement, which reduces property taxes on primary residences. The abatement ranges from about 28.1% for units assessed at $50,000 or less to about 17.5% for units assessed above $60,000. Building boards must apply for the abatement and renew it every year, and owners should verify current rates with the city's Department of Finance. A flip tax is a fee that a cooperative board charges when a shareholder sells their unit. The typical rate in New York City is between 1 and 3% of the sale price, but each building sets its own method. Some co-ops calculate it as a percentage of the gross sales price, others base it on the number of shares, some charge a flat fee, and a few use the seller's net profit as the basis. The money goes into the co-op's reserves and is not a city tax. Payment of the flip tax is a contractual term in the purchase agreement and can be negotiated between the seller and buyer. While sellers usually pay it, the obligation may be shared or shifted to the buyer depending on market conditions. Definition and process. Flip taxes originated in the 1980s when many rental buildings converted to co-ops, giving boards a way to raise capital for maintenance and improvements without increasing monthly assessments. In a co-op transfer, you sell your shares rather than real property, so the corporation can impose this transfer fee. The average New York City co-op flip tax is around 1 to 3% of the sale price. However, buildings may set the fee as a flat amount per transaction, calculated on the shares owned, or base it on the seller's net gain. Buyers and sellers should review the proprietary lease and co-op bylaws with their lawyer or attorney to understand how the fee is calculated. Purpose of a flip tax. The fee serves two main functions: it generates funds for the cooperative's reserves and discourages speculative flipping. By requiring departing shareholders to contribute to the building's capital, flip taxes subsidize maintenance collected from all unit owners and help ensure that investors do not buy and resell units quickly for profit. Residents who stay longer benefit from the contributions of past sellers, making the community more stable. WHO pays the flip tax. Although sellers traditionally pay the flip tax, the purchase contract can allocate it differently. In a buyer's market, sellers tend to absorb the fee as an incentive to attract purchasers. When demand is high, buyers may agree to cover all or part of the cost. The fee may also be split between the parties. Anyone buying or selling a co-op should identify in writing who is obligated to pay the flip tax to avoid surprises at closing. Tax treatment and benefits. Even though it is called a tax, the flip tax is not deductible on your income tax return. The Internal Revenue Service views it as a cost of selling, similar to broker commissions and legal fees. You can factor it into your total selling costs and thereby reduce your capital gains. Beyond the flip tax, co-op owners may enjoy significant property tax savings through the cooperative and condominium tax abatement, but they must meet eligibility requirements and rely on their building's management to apply. Understanding all of these costs and benefits is essential when calculating real estate transaction expenses in New York. Flip taxes are a distinctive feature of New York City co-ops, and understanding how they work can help you make informed decisions whether you are buying or selling. For personalized guidance, Sishodia PLLC, a New York City real estate law firm, offers experienced lawyers and attorneys who can review your co-op documents, explain your obligations, and help you determine whether a co-op is right for you. Visit Sishodia PLLC at 600 3rd Avenue, 2nd floor, New York, 10016 or call 833 616-4646 to discuss your co-op transaction.